Welcome to MoneyWise AI. Today, we are diving into the key financial developments of September 2025. From economic data and market movements to geopolitical risks, we'll provide insights every investor should know. So let's dive in. 1. U.S. labor market softens, setting stage for Fed rate cut. August U.S. job growth came in at only 22,000 new positions, well below the 100,000 anticipated, and July figures were revised downward. This, coupled with a slight uptick in the unemployment rate to 4.3%, signals a cooling labor market. Notably, average hourly earnings rose 0.2% month-over-month and 4.3% year-over-year, suggesting persistent wage pressures. This data reinforces the narrative of an economy that, while still resilient, is experiencing a notable slowdown. As a result, market expectations for a September rate cut have surged, with the yield curve inverting further. The Federal Reserve is now widely expected to implement a rate cut in September. This shift follows recent dovish statements from Fed officials who highlighted the need to monitor incoming data closely. In a unanimous decision, the FOMC chose to maintain policy steady in August, citing the need to assess progress toward their goals. However, several members expressed concerns about elevated inflation and the possibility of further tightening if necessary. In other news, trade tariffs, once seen as a disruptive measure, are now being evaluated as a tool to support U.S. fiscal stability. A new study by economists suggests that these tariffs could generate $3.3 trillion in revenue over the next decade. While the strategy has faced legal challenges, its potential implications for the U.S. budget and broader economic policies are significant. 2. Global markets keep rising on growth expectations, despite China Evergrande default. U.S. Treasury bonds, often considered a safe haven, saw minimal movement despite ongoing concerns about America's soaring national debt. Benchmark 10-year yields held steady around 4.2%, supported by robust demand at an auction. Gold prices hovered near record levels, surpassing $1,950 per ounce, as investors sought protection against inflation and geopolitical tensions. U.S. and European stock indices continued their upward trend, gaining around 1% each. These markets were buoyed by hopes for sustained growth, a resilient labor market, and potential Fed rate cuts later this year. Meanwhile, oil futures rose above $92 per barrel on production cuts led by Saudi Arabia and Russia. The price of Brent crude, the global benchmark, increased by more than 1%, driven by optimism about the global economy. Despite these gains, market volatility remains elevated as investors weigh the prospects of prolonged geopolitical tensions and fluctuating monetary policies worldwide. 3. Global trade under pressure. Geopolitical risks rise. Global trade uncertainties are reshaping investment strategies. Sudden changes in tariffs and trading restrictions, along with lingering geopolitical conflicts, are amplifying market volatility. According to the UNCTAD, global trade tensions are growing due to escalating conflicts and trade policy uncertainty. As geopolitical risks rise, countries are reevaluating their trade dependencies, seeking alternative suppliers and adopting protectionist measures. This trend not only affects specific sectors, but also introduces a broader risk to the global economy. In response, investors are diversifying their portfolios, focusing on defensive sectors and assets perceived as safer. For instance, there's been a notable shift towards the healthcare sector, which has shown resilience even during economic downturns. Nevertheless, this realignment comes with its own set of challenges. Investors must carefully assess the evolving trade dynamics, anticipate potential disruptions, and position themselves to mitigate the impact of these risks. Staying informed about shifting trade policies and monitoring key indicators can help investors make better decisions in this complex and changing landscape. Russia-Ukraine conflict. The Russia-Ukraine conflict continues to escalate, leading to heightened geopolitical risks. Recent drone strikes and attacks on critical infrastructure underline the severity of the situation. The conflict's impact extends beyond Europe, influencing global food and energy supplies and intensifying global tensions. As the situation remains fluid, investors are advised to closely monitor developments and their potential ramifications across various asset classes. The ongoing conflict underscores the need for diversification and a cautious approach to investments in volatile times. Middle East tensions. Tensions in the Middle East have been escalating, posing significant geopolitical risks. Conflicts in Gaza, Yemen, and Syria contribute to an unstable regional environment, impacting global financial markets. The resulting uncertainties discourage foreign investment and hinder economic growth in the region and beyond. As global investors, it's crucial to stay informed about these developments and their potential influence on your portfolio. 4. Tesla proposes $1 trillion package for Elon Musk. In a significant move aimed at retaining its influential CEO, Tesla's board has proposed a $1 trillion performance-based compensation package for Elon Musk. The proposal highlights the company's ambitious growth plans and underscores Musk's pivotal role in driving Tesla's success. If approved, this compensation plan would solidify Musk's position among top-paid executives. However, it's important to note that this compensation is contingent upon Tesla achieving substantial milestones, emphasizing the link between executive pay and the company's long-term performance. Technology stocks lead. Q2 earnings season. The technology sector has demonstrated impressive earnings growth, with companies like Nvidia and Microsoft reporting substantial increases in revenues and net income. Key drivers include the proliferation of AI and cloud computing, which are transforming business operations and customer experiences. In contrast, the healthcare sector experienced mixed results, with some major players like Pfizer seeing drops in profits due to patent expiries and increased competition. Despite challenges, the overall earnings season has exceeded expectations, reflecting the adaptability and innovation within various industries. Going forward, investors will focus on upcoming releases from giants like Apple and Amazon, which are expected to offer further insights into the state of the U.S. economy and consumer behavior. 5. Artificial intelligence revolutionizes financial markets. Artificial intelligence continues to revolutionize the financial industry, impacting everything from investment strategies to risk management. AI-powered platforms analyze vast amounts of data, allowing for more precise predictions and informed investment decisions. Moreover, AI's role in enhancing cybersecurity is crucial, safeguarding financial institutions against sophisticated cyber threats. As AI's influence grows, discussions around regulation and ethical implementation become increasingly important to ensure responsible innovation and protect market integrity. At Swift Cybos 2025, the global standard for secure financial messaging celebrated its 50th anniversary. The event brought together thousands of financial leaders to explore the digital transformation of financial services. Central banks, fintechs, and global organizations discussed the latest trends and technologies shaping the future of finance. A significant focus was on harnessing the power of data, fostering innovation, and promoting collaboration to drive the industry forward. SWIFT's continuous commitment to driving innovation and collaboration promises to shape the future of global finance. Emerging economies seek alternatives to the U.S. dollar. Emerging economies are taking steps to reduce their dependence on the U.S. dollar, driven by a desire for diversification and a shift away from solely U.S.-based financial systems. Countries like China, India, Brazil, and South Africa are increasing their reserves of gold, local currencies, and other assets to mitigate risks associated with holding a significant amount of dollars. This trend reflects a broader movement towards a more multipolar world, where financial power is distributed among a network of currencies and regions. As this trend progresses, it has the potential to reshape global financial dynamics and reduce the dollar's dominance in international transactions. 6. September 2025. Calendar events. September promises to be a pivotal month for the global financial landscape. In the United States, the release of CPI and PPI inflation reports will provide insights into the trajectory of monetary policy. Investors will also be watching closely for signs of slowing growth or persistent inflationary pressures. Additionally, the impact of tariffs on corporate profits will be scrutinized, offering a clearer picture of how businesses are navigating the challenging economic environment. In Europe, Eurozone and UK growth data will be in focus, helping to gauge the effectiveness of recent policy measures and any potential risks to the region's economic recovery. The ECB's rate decision will be closely monitored, especially regarding its impact on market volatility and borrowing costs. In Asia, China's economic reforms and progress will be watched closely as they hold significant implications for the region's growth. Japan has post-earthquake recovery efforts, and their success will shape global expectations for the country's contribution to global growth. 7. Conclusion. September 2025 marks a pivotal month for the global financial landscape. Economic indicators, geopolitical developments, and technological breakthroughs are converging to create both opportunities and challenges for investors. By aligning their strategies with these shifts, investors can position themselves to navigate the complexities of the global financial system effectively. Staying informed through continuous market analysis and expert insights is paramount for making timely and profitable investment decisions. Thank you for joining us today. Remember to hit the subscribe button to stay updated with our latest videos. Together, let's navigate the dynamic world of finance and make informed decisions for a prosperous future. Until next time, keep investing wisely.